Hi, this is Jerry. Bitcoin has fallen back below $85,000. Ethereum is struggling to hold $2,700, $2,800. Solana has slid toward the $130 area, and XRP has broken key support around $2. After touching record highs barely a month ago, the crypto market has just erased over $1 trillion in value in a matter of weeks. Let's unpack what actually happened, why the sell-off is so violent, and what it tells us about the current crypto cycle. Firstly, let's check the price changes for all cryptocurrencies. As of 21st November 2025, Bitcoin trading around $84,000, $86,000, down roughly 8-10% in the last 24 hours, and more than 30% from October's all-time high above $120,000. ETH around $12,700 to $2,800, its lowest level in about 4 months, and down 15% to 20% from recent local highs near $3,300 to $3,600. Solana hovering around $130s to $140 after a multi-week pullback from above $180. Intraday, bulls are fighting to defend the $130 support area. XRP trading just under or around $2, having repeatedly lost and retested support zones at 2.10 to 2.3, with weekly drops exceeding 10% to 15%. At the index level, total crypto market cap has shrunk by roughly 7% to 8% in a single day, and over $1.2 trillion in the last 6 weeks. Bitcoin dominance remains elevated above 58%, but that dominance is masking the fact that everything is under pressure. However, this isn't just a normal correction, it's a regime shift in risk appetite. The first driver of this crash is not native to crypto at all, it's macro. Markets spent much of 2025 front-running aggressive global rate cuts. That narrative has cracked. Recent data have revived fears of sticky inflation and slower than expected easing by major central banks. As rate cut expectations are repriced, yields push higher at the margin, and future cash flow assets, tech stocks, high-growth names, and yes, crypto take the hit. For institutions, this is a simple equation. If risk-free yields look more attractive and recession odds rise, crypto is the first asset out the door. It's still seen as a pure risk-on bet, not a defensive hedge. While BTC, ETH, and friends are bleeding, gold and silver have been rallying. A classic sign that capital is rotating into perceived safe havens. Recent reports highlight that as concerns about credit risks and fiscal sustainability grow, gold and silver have outperformed while major cryptocurrencies slid. In other words, the digital gold narrative has, in the short run, lost out to the original metal. The second driver of this crash is market structure. When Bitcoin broke convincingly above 6 figures earlier this year, it didn't just attract long-term holders, it drew in a huge wave of leveraged traders betting on a one-way move higher. As BTC consolidated around the psychologically crucial $100,000 level, that zone became crowded with leveraged long positions. Once BTC slipped below 100K, what many thought was a solid support turned into a trapdoor. A cascade of forced selling followed as margin calls hit. In a short span, more than $19 billion in leveraged positions were liquidated across BTC and major altcoins. The result? One of the sharpest drawdowns of this cycle, with Bitcoin plunging from around 120K in October to the mid-80K region today. On 21st November alone, live liquidation trackers flagged 1 billion wiped out in just 60 minutes as BTC sliced lower and dragged the entire complex with it. When that happens, it's no longer about fundamentals or long-term narratives. It's about who can post more collateral, who gets liquidated next, how shallow the order books are once everyone heads for the exit. Bitcoin remains the macro barometer of crypto. Reports now show BTC at a 7-month low near 85K, with the coin having given back all its year-to-date gains and drifting into negative territory for 2025. That matters because many public companies with Bitcoin treasury strategies are deeply in the red. Crypto equity proxies in Japan and the US have seen drawdowns of 70% to 80%, amplifying the sense of capitulation. Earlier in the year, Bitcoin ETF had been a relentless inflow machine. Now, ETF flows have turned mixed to negative. Analysts highlight persistent structural weaknesses, namely reliance on momentum-chasing retail flows and leverage derivatives as key reasons why the November crash was so violent. In other words, Bitcoin is acting less like digital gold, more like a high beta macro trade. Next, let's dismantle every major cryptocurrency's performance. Its story is more nuanced. Entered November with cautious optimism. Some analyses pointed to a potential breakout toward $3,750, $3,800, contingent on holding key support zones. Instead, macro pressure yanked ETH back below $3,000 towards the $2,700 to $2,800 region, highlighted as a critical support band. Today's price action shows ETH down over 2% intraday and roughly 8% to 10% on the week, mirroring the BTC slide. Fundamentally, ETH still benefits from DeFi and staking demand, which keeps a large portion of supply locked. Robust developer ecosystem and its reserve asset role in the on-chain economy. How about Solana? Solana has been one of the standout L1 winners of this cycle, which is exactly why it's getting punished now. After a powerful run earlier in 2025, with price targets as high as $200 to $250 being floated for year-end, Sol is now battling to hold the low $130. Recent price analysis notes that as long as $131 holds, a short-term rally back toward $167 is possible, but a clean breakdown below that level reopens the path to deeper losses. In other words, Solana is back to behaving like the market's high beta instrument. It outperforms on the way up, underperforms on the way down. Let's move to XRP. XRP's story this month looks almost contradictory. More institutional-style products, weaker price. New XRP-linked ETFs and ETPs have launched, bringing fresh liquidity and giving traditional investors exposure to the token. Yet, the price has been trapped in a descending structure for months, with rallies rejected and support zones around $2.10 to $2.30 repeatedly failing. In the latest leg down, XRP slipped below the $2.10 key support, briefly bouncing from just above $2 before sellers stepped back in. Institutional activity has actually declined, according to market reports, suggesting the ETF launches are not yet offsetting broader risk-off sentiment. XRP is a good reminder that new wrappers don't change the underlying risk if the macro tide is going out. So, what do these dramatic moves actually tell us? The scale of liquidations, the presence of ETFs, and the reflexive interaction with macro data all point to a mature cycle, not the Wild West early days of 2017. Crypto is now integrated into the broader risk complex. When the S&P and mega-cap tech wobble, crypto doesn't just correlate, it amplifies the move. Even with more spot-based products and long-term institutional holders, the marginal price is still dictated in perpetual futures options and leverage tokens, along with flash-style liquidation events where billions can vanish from open interest in an hour. As long as that remains true, every macro scare will be expressed as a leverage purge first, fundamentals later. Bitcoin's digital gold status isn't dead, but it's clearly time horizon dependent. In a multi-year lens, the halving, scarcity, and adoption story still resonates. On a 3-month horizon, it's a high volatility macro chip. ETH's DeFi and staking flywheel is intact, but regulatory uncertainty and tech stack debates force investors to attach a higher risk premium. Solana's speed and ecosystem growth are undeniable, yet its higher beta means it will absorb disproportionate damage when the tide turns. XRP's efforts to institutionalize via ETFs show that product innovation isn't enough if liquidity is exiting the asset class as a whole. Right now, the market is balancing three broad scenarios, as some analysts outline. First scenario, macro stabilizes, crypto rebounds. Central banks signal clearer easing paths, risk assets recover. Bitcoin reclaims the high 90K to low 100K band. ETF moves back above $3,000. High beta names like SOL and XRP stage outsize bounces. Second scenario, sideways grind, volatility sellers take over. Rates remain higher for longer, but no major new shock hits. Crypto chops in wide ranges. BTC between 70K, 95K, ETH 3,400, 3,200, SOL 110, 170, XRP 1p80, 2 calls 40. This regime is painful for over-levered directional traders, but offers rich premiums for options and basis strategies. Third scenario, deeper risk-off. Tourists exit the space. A sharper economic downturn, major credit event, or policy misstep leads to another wave of de-risking. Crypto, still viewed as expendable in institutional portfolios, suffers further double-digit drawdowns. None of these scenarios invalidate the long-term case for digital assets, but they do underscore a key reality of late 2025 markets. Crypto is no longer an isolated frontier. It's plugged into the same global macro machine as everything else. And when that machine shifts gears, the digital asset class moves faster and further than almost anything else. For traders and investors alike, the lesson from this latest crash is simple but brutal. Price is still a function of liquidity and leverage first, and of narrative second.